It's a specific kind of silence. The kind that falls over a boardroom, a trading floor, or a compliance department after the collapse. It's the silence of retrospective clarity. The deafening quiet after the noise of a multi-billion-dollar fraud finally stops. And in that quiet, when the dust settles and the forensic accountants start tracing the ghosts of transactions, a single, profane, and deeply human question bubbles up from the wreckage. You look at the audited financials that were pure fiction. You look at the performance charts that defy statistical possibility. You look at the impossibly smooth upward curve that never saw a down month. And you ask yourself, you ask your team, you ask the heavens, what is this Diddy blood doing on the calculator? It's not a question of sophistication. It's a question of absurdity. It is the realization that the scheme wasn't a work of financial engineering genius that outsmarted your models. It was a lie. A simple, brutish, almost insulting lie. A lie so fundamentally stupid that your intellect, your training, your entire professional worldview was conditioned to look right past it. You were stress testing for black swan events, modeling tail risk, and running Monte Carlo simulations. Meanwhile, the fraudster wasn't even playing the same game. They were just punching numbers into a calculator that weren't real. And we, the sophisticated, the professional, the elite, we validated it. We built cathedrals of due diligence around it. The most dangerous frauds are not the ones we can't understand. They are the ones we refuse to believe could be so simple. Let's talk about the king, the chairman, Bernard L. Madoff. For decades, he was not a fraudster. He was an institution. The Madoff feeder funds were a status symbol, a ticket to an exclusive club of guaranteed returns. His strategy was supposedly a split-strike conversion. It sounded complex, plausible. It involved buying a basket of S&P 100 stocks and hedging them with offsetting options contracts. The narrative was bulletproof. He had the reputation, the access, the mystique. He was the former chairman of the Nasdaq. But what did the calculator say? Harry Markopoulos, a derivatives analyst and professional skeptic, started running the numbers back in 1999. He didn't need a supercomputer. He needed basic logic. Madoff's reported returns climbed upward at a near-perfect 45-degree angle, month after month, year after year. Through the dot-com bust, through 9/11, through the credit crunch. Positive returns? It was a statistical anomaly, so profound as to be an impossibility. As Markopoulos famously pointed out, a fund that size, executing that many options, would have left footprints. The options market for the S&P 100 simply wasn't large enough to accommodate the trades Madoff claimed to be making. The trading volume wasn't there. A first-year quant, tasked with a simple regression analysis of Madoff's returns against the broader market, would have discovered a beta of almost zero. He was supposedly generating market-beating alpha, with no discernible market risk. This isn't just unlikely, it violates the fundamental laws of financial physics. It's the equivalent of a physicist claiming to have invented a perpetual motion machine. And yet the world's most sophisticated funds, private banks, and high net worth individuals poured billions into it. They performed extensive due diligence. They wrote 100-page reports. But did any of them perform the simplest test? Did they ask the calculator question? The question wasn't, how is his complex option strategy generating this alpha? The real question was, what is this Diddy blood doing on the calculator to produce a 45-degree line? The answer, we now know, was nothing. He wasn't trading. He was taking new money to pay off old investors. The oldest, simplest trick in the book. A Ponzi scheme. The calculator was just a prop. Why do we miss it? Why do rooms full of CFAs and PhDs fail to spot a fraud a skeptic with a spreadsheet can uncover in 5 minutes? The due diligence process becomes a process of confirming his genius, not questioning his premise. Second, social proof. When you see names like Banco Santander, HSBC, and Fairfield Greenwich Group on the client list, You don't think fraud, you think exclusivity. You think if they're in, they must have done the work. It creates a cascade of deferred responsibility. Each investor relies on the perceived diligence of the others, creating a collective delusion where nobody is actually checking the fundamentals. Everyone assumes someone else has checked the calculator. And third, perhaps the most insidious for our profession, is complexity bias. We have a preference for complex solutions over simple ones. The idea that Madoff's returns were generated by a simple lie is frankly insulting. It's embarrassing. It suggests we were duped by a carnival trick. It is far more intellectually satisfying to believe we were outmaneuvered by a sophisticated, unknowable strategy. We would rather be wrong about something complex than be right about something embarrassingly simple. Our entire industry is predicated on finding signal in the noise, on building intricate models to capture alpha. We are not trained to spot the simple, glaring lie. We are trained to look past it for the real story. This isn't ancient history. The same pattern repeats, just with new narratives. Let's move to Germany, to Wirecard AG, the fintech darling, the payments giant, the future of European tech. The story was compelling. A complex global web of payment processing, particularly in opaque Asian markets where growth was explosive. The numbers were staggering. The stock was a core holding in countless European funds. But then the question started. The Financial Times, led by journalist Dan McCrum, began pointing out accounting irregularities. For years, the company and its auditors, Ernst & Young, batted them away. The explanations were always complex, involving third-party acquirers, escrow accounts, and the intricacies of international fund flows. The analysis from the sell side was dense, focused on take rates, total payment volumes, and synergy models from acquisitions. Everyone was doing PhD-level math on the company's future. What was the calculator question for Wirecard? It was this. Does the 1.9 billion euros of cash you claim to have on your balance sheet actually exist? It was the most fundamental question of forensic accounting. For years, auditors had accepted confirmations and screenshots from trustee accounts in the Philippines. They trusted the paper trail. But in 2020, the pressure became too great. The new special auditor from KPMG couldn't verify the cash. EY was finally forced to do what they should have done years prior, directly confirm the balances with the banks themselves. The Philippine banks responded. The documents were spurious. The accounts never held the money. The money was never there. The 1.9 billion euros, a third of the company's balance sheet, evaporated overnight. The company collapsed into insolvency. The CEO was arrested. What was the Diddy blood doing on the calculator? He was adding a number, 1.9 billion, that was pure fiction. And for years the entire European financial establishment played along, too caught up in the narrative of fintech disruption to ask the simplest question. Can we please count the cash? And that brings us to the most recent, most spectacular implosion. FTX, the crypto wunderkind. This wasn't old world finance, this was the future. Web3, decentralized finance, Serum, Solana. But the collapse revealed a truth that was, once again, insultingly simple. We have the sworn testimony of John J. Ray III, the man who cleaned up Enron and was appointed the new CEO of FTX. In his initial bankruptcy filing, he described a situation so lacking in basic controls, it beggared belief. He wrote of a complete failure of corporate controls and a complete absence of trustworthy financial information. And here is the calculator moment for FTX. Ray revealed that this $32 billion global crypto empire, this beacon of the digital future, used QuickBooks for its accounting. QuickBooks, an off-the-shelf software package for small businesses. There were no reconciled accounts, no proper records. Corporate funds were used to buy homes for employees. Customer funds were commingled with corporate funds and funneled to its sister hedge fund, Alameda Research, to be used for high-risk, leverage bets. The fraud wasn't a sophisticated hack of a smart contract or a flaw in the blockchain S cryptography. It was embezzlement. It was taking customer deposits and gambling with them. It is one of the oldest and most regulated against sins in all of finance. It's what Glass-Steagall was written to prevent. It was a failure of controls so basic that it was comical. What was this Diddy blood doing on the calculator? He wasn't even using a calculator. He was scribbling on a napkin, moving billions with no oversight, no risk management, and no paper trail. All while the most sophisticated investors in the world lauded him as a generational genius. They were investing in the narrative, not the numbers, because the numbers, had anyone been allowed to see them, were a catastrophic mess. So where does this leave us? It's tempting to point fingers at Madoff, at Marcus Braun of Wirecard, at SBF. They are the fraudsters. But the uncomfortable truth is that the Diddy blood on the calculator aren't always the perpetrator. Sometimes that person is in the mirror. It's the portfolio manager who accepts a manager is self-reported numbers without independent verification because the returns are just too good to pass up. It's the analyst who builds a beautiful DCF model based on management projections without ever asking if the foundational revenue assumptions are real. It's the risk officer who sees a counterparty with a stellar reputation and greenlights a massive exposure, glossing over the fundamental due diligence of segregated accounts and asset verification. We build these intricate models, these temples of financial analysis. We debate Sharpe ratios and Sortino ratios. We argue about alpha versus beta. We get so lost in the elegance of our own calculations that we forget to check if the inputs are grounded in reality. We are measuring the velocity of a ghost. We are calculating the trajectory of a phantom. So what is the defense? It's not a better algorithm. It's not a more complex AI. It's a return to first principles. It is a philosophy of radical, almost militant skepticism. First, trust nothing. Verify everything. As Clifford Asness of AQR Capital famously stated, there are no alpha fairies. Returns that are too smooth, too consistent, and too uncorrelated with any known risk factor are not a sign of genius. They are the single greatest red flag of fraud. Your default assumption should be that it's impossible, and the burden of proof is on them to prove otherwise, with independently audited, verifiable data. Second, analyze incentives. Cui bono? Who benefits? Follow the money. Always understand the fee structure. Is the manager incentivized to generate real returns or just to grow assets under management? Is the auditor's relationship with the client too cozy? Are they a client or a captive? A rigorous analysis of the incentive structures surrounding an investment can reveal more than 1,000 pages of financial statements. Finally, embrace simplicity. When you ask a simple question, demand a simple answer. If you ask a fund manager, how do you make money? And the answer is a blizzard of jargon, a word salad of opaque strategies and proprietary black boxes. You should not be impressed. You should be terrified. Obfuscation is the primary tool of the fraudster, and clarity and transparency are their enemies. If they can't explain it to you in a way you understand, it's for one of two reasons. Either they don't understand it themselves, or they don't want you to. Both are catastrophic for your capital. The ultimate defense mechanism is to cultivate and trust that nagging feeling in your gut. That small voice in the back of your mind that pipes up in the middle of a presentation when a chart just looks too perfect, or an explanation just doesn't quite connect. That is the moment of truth. That is the moment to stop being impressed by the complexity and to start questioning the premise. It is the moment to put down the 50-page pitch book, to look at the simple numbers on the page, and to ask with all the professional conviction you can muster, what is this Diddy blood doing on the calculator? Because asking that simple, crude, and deeply skeptical question is the first and last line of defense against the next great financial lie.